So a hard money loan is really just a bridge loan. It's really just a bridge loan from a private lender, an unregulated lender. So what are the benefits of hard money loans? Why do investors, first-time flippers all the way to investors with thousands of units? So I've closed over $1 billion in hard money loans, and I can assure you one thing, not every project qualifies for hard money. Michael Chadwick here, and today we're going to talk about property types. Which property types qualify for hard money loans and which property types don't, which have the highest probability of closing with a hard money lender and which ones don't. And we're going to discuss it in this video. So if you're an investor, if you're looking to access hard money loan programs that offer speed and flexibility, but you have a property type you just don't know whether it qualifies or not, we're going to clear it up in this video. So before we get into the different property types and talk about which property types fit better for hard money loans versus another, the one thing that I'm going to continue to focus on and talk a lot about on my channel is the exit strategy, right? You could have the best property in your mind, the perfect credit, but if that property is not sellable, it's not refinanceable, there's no clear exit, I think any bridge lender, any hard money lender is going to struggle to make that loan. And the exit could be that they're willing to foreclose on that property to take the property back and then liquidate it themselves. That's not an exit strategy that any of us want, but that's actually in play when it comes to old school hard money lending. At the end of the day, the lender has the ability to take the collateral back and liquidate. We don't want that to be our exit strategy. As a lender, I can assure you, we like to shuffle paper and make money. We don't want to own and operate real estate. So that's the last thing we want to do. But there are lenders out there who will rely on that as their exit. And that's, to me, the purest form of hard money lending. Now, that said, post-financial crisis, hard money lending stepped in and really filled a void in the market for what I believe is transitional bridge loan type lending that the banks typically could have filled that void, but the overregulations just didn't allow it. So we're, as a private lender, open for business, trying to make loans on and fill the void on a number of different property types. So now that we've got the exit strategy discussion out of the way, let's get into property types. And the major property types that I'm going to focus on here are going to be single family properties, both fix and flip and new construction, rental properties, 2 to 4 units, 5+, which is going to be my multifamily properties. We're going to talk about commercial properties, which would be office, retail, industrial, some flex industrial, some mixed use. And then we're going to talk land deals because, I see land deals all the time. It can mean subdivision. It can mean one-off A&R lots, approval not required. We can talk about that too. But those are the main, we'll call it food groups, main property types that we're going to get into in this video today. Single family fix and flips. The easiest property type to finance for a hard money lender as far as I'm concerned. You can be a 0 experience flipper. You can be a 15 experience flipper. Hard money loans are used by pros and noobs alike, and really are the sought after property type for hard money lenders. It's a property type that I feel hard money lenders really glommed onto post financial crisis when the banks became overregulated. I personally did over 100 fix and flips myself, and I came into the space of lending to fill that void, and I think that's what hard money lenders do. They're really good at finding and financing fix and flips, and that's because the exit strategy is clear, right? The lenders know that there's a market and a very clear value for a renovated product in that particular area, and as long as the borrower can execute, they know they can sell it for a number. And if they can't sell it for the number they thought, they know at some point it can be liquidated. And ultimately, if it has to happen and the borrower gets foreclosed on, they can still take the property back and get their money and repay their debt. So the bottom line is that single families, because the exit strategy is so strong and the market is so liquid, it's a very easy loan to make for a hard money lender. And oftentimes it's just going to come down to the borrower's experience as to whether the loan will close or not. That's really, I would say, the number one property type, fix and flips, bread and butter. Next is going to be 2 to 4 unit rental properties. I think it's like 1A, 1B in terms of the most sought after property type for a hard money lender, right? Because 1A in the single family respect is pretty liquid, right? There's a lot of buyers for that. But 1B, we'll call it in the 2 to 4 unit rental properties, the exit strategy is also very strong because you have theoretically in-place tenants paying rent that will cover the debt service payment. And so the fallback option, other than to sell a property property is to refi. And with the 2 to 4 unit properties, it's pretty highly, likely that you're going to be able to get a refi done, assuming you have a certain minimum credit and the property's cash flow meets a certain debt service coverage requirement. Their LTV is there. And as a hard money lender, a bridge lender, we're going to make sure that the exit strategy is there on the takeout. So we're going to underwrite to a refi of that 2 to 4 unit to make sure that when we make that loan, we're making it not just positioning the borrower to be forced to sell, right? We want to make sure that the borrower wants to execute their strategy. And if it's a refi, we're going to underwrite to a perm lender guidelines so that we make sure that the borrower's chance of success is really high, and obviously our loan gets repaid in the process. So 2 to 4 units, really strong. Here at Asset Based Lending, we have both long and short-term programs for 2 to 4 units. And that, just again speaks to having yet another exit strategy for borrowers. Again, that's the common theme with these types of loans. And next would be the multifamily units. They're going to be the 5+ unit properties. I see properties really as high as, say, 75 to 100 units. I used to, in my previous life, finance the institutional 200 unit properties. It's tough to get a project like that done in the bridge space. It happens. And there are lenders, as I will always say, for every seat. So, usually that type of money tends to be, less programmatic, more one-off, and it's certainly there and ready and willing to fund deals for borrowers who are looking to do that value add type transitional play, whether it be a renovation of the units to bring the units to market, or whether it's simply a loss to lease play where market rents are higher than the lease in-place lease rents, and that could be as simple as the value add play to justify a bridge loan. Either way, those loans are a little bit more difficult to do. The exit strategy isn't like a 1 to 4 unit or a single family where you have a huge, massive pool of buyers. So in those situations, when you're looking at a multifamily bridge, we're going to be looking at the borrower's experience, but not just on their ability to execute the reno, but their ability to take the project through and actually successfully refi out a bridge loan. So the key with the multifamily bridge loans is simply the exit strategy, as always, but underwriting the income to make sure that it supports the loan in a full refi of the loan. And that could be stressing interest rates. It could be stressing, LTVs. It could be doing a number of things just to make sure there's room for the lender and the borrower, quite honestly, to refi the bridge loan, the hard money loan out when the time comes and the project's either complete and stabilized or what have you. So the next property type I would say is going to be the commercial properties. And we're going to talk about those as being, let's call it office, retail, industrial. I'm going to call it mixed use, property types like that. You might have single tenant retail like a CVS. You might have project with a stop and shop and inline retail. You could have a number of different types of projects. I financed, industrial flex, office industrial. I've done multifamilies like we talked about. And I think the reality is the bigger transactions, the industrial, the larger multifamily, let's call it the retail, the office, just generally take longer. They take longer to transact. They take longer to tenant. They tend to be less diversified because ultimately your tenants are businesses that you're underwriting, and maybe there's uncertainty with said business versus people need a place to live. And owning a rental property and knowing the market occupancy gives you some level of certainty that there's going to be somebody coming in behind the tenant that leaves that's going to replace that tenant. And that income's pretty stable as a result. Office property, especially these days, has seen a lot of volatility. There's a lot of vacancy. Industrial properties seem to be in high demand just with what we're seeing in terms of Amazon and regionalization of shipping centers and all of that. So every lender has their specialties. I'd say the bulk of what you're going to find in terms of hard money loan programs are going to be focused on resi. I think that's something that has emerged post-financial crisis. It's going to continue to get better and stronger, more competitive. And you're going to find that the lenders looking to do commercial deals are going to be, I'd say, few and far between. And when you have a deal that makes sense from an LTV perspective, it could be a really low LTV deal. It could be a super strong cash flowing. You're going to have the opportunity to go to the market and test a hard money lender to see if there's interest because there's equity there. There's certainty to maybe exit that may not be like an average office industrial retail deal that may get a lender to be compelled to take a risk. So never say never. I think what we're talking about here is high probability to low probability. And I think in the list high to low, you're going to see more of the commercial segment as a lower probability because it just doesn't lend itself to speed. And I think that in itself, coupled with the lack of certainty to exit in terms of the perm lending space for office, retail, industrial, it just becomes harder for bridge lenders to make that leap and take that risk and make that loan. In terms of commercial properties, I think that's pretty much, I think you're going to see the pool of lenders shrink dramatically to a fraction. But again, partly why I love the space is that never rule it out. There's always a lender out there that's willing to take the risk, do your due diligence, and try to do your best to find that particular lender because there's an ask for every seat. In terms of land deals are, I would say, fall along the lines of the commercial projects in terms of the lender pool. You have lenders willing to step into land deals that are permitted shovel ready, obviously, where they can come in and fund vertical. You have a lot fewer lenders, I would say, that are willing to step in and fund horizontal infrastructure. If you have a deal where you're looking, or I say a buildable lot that you're looking to finance the purchase of and the construction of a new house, you're going to find a lender to make that loan all day long, right? Because there's no entitlement risk. Really, there's no permitting risk. And the fact is, as long as your experience suggests you can execute the construction of a new house, we know as a lender that there's a number of people, millions, that would buy a new house, would love to have a new house. There's a lack of supply, so we're going to make that loan. What lenders have trouble funding is going to be the subdivision work, the land and horizontal infrastructure work, the pre-development work, the spec work, really that goes along with development risk, that goes along with why developers get paid such a high return. It's really not a risk profile that a lender wants to take, or quite honestly, not that many investors either have the appetite for or the skill to be able to execute. The borrowers that are looking to acquire and deal with land and deal with subdivisions and deal with pre-development work are going to have trouble finding lenders. The pool is going to shrink dramatically, but the money is there. I feel like there are national lenders that will do it, and then there are local lenders that'll step in and do it. There are builders who will fund other builders to take projects through. That's, again, the beauty of the hard money space. But when you're looking for programmatic, let's call it institutional land, hard money or bridge loan programs, they're few and far between. They're going to really look closely at your experience. They're going to look at the numbers. They're going to want to make sure that the dollars they're putting in are going in to add value to the project. Because if you think about it, they can't see their money going in on a land deal. They can see their money going in on a ground up construction deal, though, because they can see the foundation going in. They can see the framing going in. When they lend against that construction, they're seeing the value improve. With land and pre-development deal, it might be time to drag the utilities underground to the cul-de-sac that completes the subdivision, but you may not even see that work. It might just be dirt. You might not see any value in that until the lots are conveyed or the construction, but you might not see profit until lot 8. So there's a lot to it. Land deals are generally tough. I say that if you're willing to come in and put the land together with the vertical construction, your probability of getting your loan funded increases exponentially. But just generally land and just raw land in general is probably going to be difficult. And land and pre-development loans are just one click easier, but not that much easier in terms of getting done. You just have to have an appetite for that risk. You have to know the zoning, the risk it takes to basically get a project through and developed. And I think that inherently lends itself, pun intended, to a local lender. When it comes to land deals, you have to have an appetite for being in the deal for a long period of time, which just doesn't lend itself to hard money. In fact, I've had 2 foreclosures in my past, and they were on subdivisions because the deals just needed to be out 24 to 36 months. That's just too long when you're dealing with rates at 12, 13%. On a projects like that. So when it comes to land, look at it carefully, but in general, always be looking at the exit and know how long your project is going to take to see if in general it even fits to begin with. Hard money loans are never limited to a certain property type. I mean, sure, you're going to have lenders out there that favor certain property types over others, but in general, there's a hard money lender out there for you. If you have equity, skin in the game, you have a clear exit strategy. It could be an office industrial. It could be anything. It's a property, it's financeable with a hard money lender. You just need to meet their particular criteria. And again, that's what I love the most about this business. You can have a lawyer, doctor, dentist, friends and family, all the way to an institution, making a loan on an investment property for the benefit of a borrower executing a strategy. There's a lender out there for that. But I think what's become clear over the last decade is that hard money lenders like asset-based lending, who's sponsoring this video, focused on the residential space. They focused filling the void in the fix and flip, the ground up construction, the rental space, because that's what borrowers needed this money. Investors needed a non-bank execution to be able to compete with investors who had cash, investors who were well capitalized that could move quickly, or otherwise they simply couldn't have transacted. So when it comes to this hard money space in terms of probability, when you're looking at a property type, as long as it's a residential property, I would say 1 to 4 unit, single family is going to be the highest probability in terms of getting the loan closed and executed with the best terms. Then it goes multifamily 5+, and then down the line to office, industrial, retail, and depending on the lender, you're going to see different priorities. In terms of loan size, that's also going to come into play, but we won't get into that now. I think the fact is residential properties are going to be the most sought after. And when you're talking about accessing the best programs, and that's the typical hard money, the 12-month fix and flip type loan, the ground up construction loan for resi. There's really not many lenders out there that can do it as well as ABL in terms of point structure, in terms of keeping the cost down, but executing on average in 10 days in keeping the project moving. And when you focus on certain property types, again, it could be that you're lending on office and you do that really well. If you do what we do in the residential space, you come to know the business so well and you learn the ins and the outs. And it's not just the execution that you end up worrying about. It's about how to service a loan and a client all the way through till the repayment, the exit of the deal. And I think that's what groups end up doing. They end up focusing on property types to be able to execute for their borrowers like ABL can in the residential space. And I think that's going to continue. And I think you're going to see professional flippers, professional builders, whether you have perfect credit and you have thousands of projects under your belt or you're a first timer, they're going to continue to rely on hard money loans to fill this void. And I can't wait to continue to be here for my clients to make those loans and to continue to watch them grow. As always, I'd like to thank my sponsor again, Asset-Based Lending. Please like, subscribe, comment if you have any questions. I'm always here to answer any questions you have. And be sure to look out for my next video. We're going to continue to make videos on hard money lending and how to use this program to grow your real estate portfolio.